Hey, Andrew here from The Investor's Way, and welcome to Woody's Weekly Wisdom, episode number 44. And we have to do it. It's the start of the new year. Well, we're already into February, but start of the new year when it comes to this particular topic. And here's today's headline that we're going to be looking into, and the article attached to it. Cannot be ruled out. RBA's big rates call. So RBA, Reserve Bank of Australia, their big interest rate call for the year at their first meeting of the year. So let's pull it apart and let's see what all the talk has been before and since the big rate call that they've made, and what this article is all talking about. So what can't be ruled out? And so all the talk leading up to the first RBA meeting was, would rates remain on hold? What would the RBA be talking about in terms of the forecast for the year? And could borrowers be looking at some form of relief at some point this year, after last year being an absolute disaster for borrowers, with rate increase after rate increase after rate increase? And so in November, the last rate increase hit, and we all thought that was probably one step too far. After they had paused for a couple of months, we thought maybe there's some relief in sight. The numbers are looking good around the world. So at that point, the US was dropping dramatically and their inflation was coming down rapidly. And so we thought maybe the RBA would pause things here in Australia. But no, we got the interest rate hike in November. So I thought, since we haven't spoken about interest rates for about 2 minutes, it might be time to have another chat. And so here we are. We're looking at this article. And as always, the article needs to start with the stab, and that is, what is it that can't be ruled out? And RBA's big rates call. So I'm pretty sure you're smart enough to realise what this article's saying can't be ruled out. And if you guessed more rate rises, then that's exactly what this article is trying to get us to believe is going to or can't be ruled out. And so I guess it's not the journalist's fault, because the RBA has literally come out and said that further rate rises can't be ruled out. But the problem is that everything else paints a very different picture. And that picture basically is saying that all the numbers are moving in the right direction. And so there's lots and lots of commentators around at the moment who have got their 2 cents worth on interest rates. I'm not necessarily going to make any bold predictions. You've got basically the consensus is that the rate rises are over, and that at some point this year we're going to see reductions. And so there's some that are saying as early as August, others that are saying as late as November before we see those rate reductions. But if we go through this article, they've kept rates on hold, which is a great thing for Australian borrowers. And we start seeing some of this analysis where basically people are saying that rates should remain. So the NAB is saying that rates should remain on hold for quite a while, and that further increases from the RBA board can't be ruled out. Well, they can't be ruled out because last time they suggested that rates weren't going up, they had to turn around and put them up, and they got absolutely blasted by borrowers who'd made decisions off the back of commentary from the RBA. And obviously the commentary is important. We rely on the commentary to inform us as lenders, as borrowers, about what we're going to do. And so when they come out and say, no, we don't think there's going to be any rate rises for a couple of years, people made decisions based on that, and now they're paying very dearly, both in the amount of interest they're paying, but also in the strain that's putting on their financial circumstances. But if we go through the article, the key here is that in Australia, as we're seeing around the world, inflation is dropping. And we're seeing that we're getting closer and closer to the desired range. We're at 4.1%, so we've got to get down into the threes, and that'll be where I think we start to see the RBA talking more positively about reductions, if we can get that inflation down to into the threes. And also looking here, basically, as I said, so inflation comes down and they'll start cutting rates. That's somebody here, I think it's from, again, the NAB. So basically reflecting what we're saying here. And then we see that the CBA is in similar thoughts, basically saying that it was a pretty straightforward decision this month to keep rates on hold. Inflation down to 4.1 compared to expectations of 4.5. So that's all very good. The job market, it hasn't exploded, which is always a risk for inflation and for interest rates. So that's under control. Inflation coming down. So all the things that the RBA has been looking for to take out the sting are starting to happen. So that's all very, very good. And look at this. The CBA is forecasting a 0.75% of cuts in 2024. So that's more than likely 3 cuts in 2024. That's probably at the high end of expectations. But I think once they start cutting, they will cut them pretty quickly, because they are, although they're probably at historical norms, they're not at modern norms. And so they're still, quite restrictive on borrowers. And let's not forget that we still have hundreds of thousands of people that are on very low fixed interest rates. And when they come off the 2% rates and the 1.8% rates, come up to the 6% rates, that's going to impact their spending capacity as well. So, the consumers are doing their bit. They've reduced and cut back their spending. And now we just need to see those rates come down as inflation continues to come down. And so what does that mean in terms of your finances and your budgets or money plans? Hopefully not a budget, but a money plan. And what does it mean for investing and growing your wealth? Well, simply, there's more confidence as such in your decision making if you know that in this particular year it's less likely that rates are going to go up and more likely that they're going to come down. You can factor that into your decision making when it comes to your investing, and also factor it into your capacity to put money into investments that maybe you might have hung on to if you thought that rates were going to keep going up and you would need that cash to meet your interest expenses. So that's the good news. The positive side of all of this commentary and the trajectory of interest rates is that we're hopeful that they're going to be coming down. So when it comes to your wealth, you can make more confident decisions knowing that we're heading in the right direction on interest rates. Now, I say that obviously with the caveat that we've been down this path before where the RBA said rates weren't going to go up, and they did. So just be mindful of that. But the data at this point is all pointing in the right direction. This section of the article just starts talking about the threat that banks won't necessarily pass on the full extent of the cuts, and that they will try and maintain higher margins in the gap between what they pay and what they lend. That's a common, constant battle, and as you can see over a period of years, the last 20 odd years, their margins have dropped, and then they started to increase again. They've come back down a little bit. Banks have got to borrow money to lend it, and so we'll be hopeful that they will pass on most, if not all, of the rate cuts when they come. But I wouldn't hold your breath. I think there'll be a little bit of hanging on to replenish their margins for their profitability and their shareholders. So, as I said, this is some good news. The flip side of this is there was another article that I was considering looking at for today's Weekly Wisdom episode, and it was all about the pressure that people are finding when it comes to buying their groceries and the rate that they've gone up over the last 12 months. So just so you know, there was another article which basically said that the average grocery spend has gone up by $10 over the last 12 months. Now, that doesn't sound like a lot, but and I suspect that most people are saying it's gone up a lot more than $10. And I know from even just our small grocery spend, it's definitely gone up by more than $10. But they, as I said, they use the averages, and $10. They were saying the average weekly spend was $188, so $10 is over 5%. So it's quite significant, and it's caused a lot of people to amend the way they spend their groceries. People are looking around for discounts and shopping at multiple grocery stores to get particular items that are on special. That's all very smart and wise things to do. They all compete with each other, and 1 week they'll be on special. Something will be on special in one of the big stores, and the next week it'll be on special in the other. So if you can, use that to your advantage and pick up those discounts or bargains where you can to bring your grocery costs down, whilst these interest rates are putting so much pressure on the household money plan. So the thing to take out of this, I believe, and the message I want you to take from today's weekly wisdom, is that we are seeing some good signs when it comes to the next 12 months worth of interest rates and the movements in interest rates. And the predominant prediction is that they will come down at some point in 2024. And I know, as I said, I'm seeing that in lots and lots of different forms of media or commentary that I look at. And so I think we can, fingers crossed, predict that we will get some relief when it comes to interest rates throughout this year. So again, what that then means is you can have a lot more certainty in your investing strategies for the year, because you know that if you've got some funds available, you should be able to get that into some investments without having to store it for potential interest rate rises. And that's great, because we want to get our money working for us for as long as possible so we can be financially free sooner rather than later. So that's this week's article, all about interest rates for the start of the interest rate cycle for this year. And as I said, the article cannot be ruled out further interest rate rises, but ultimately, I believe all the data is pointing towards the less or the more likely outcome is that rates will stay steady for a little while and then start to come down in the second half of the year. So we look forward to seeing if that comes about, and if it does, we can now start talking about what you're going to do with that new money that is available for taking pressure out of your money plan, and also being available for investing purposes to get working for you to secure your financial future. So that is Woody's Weekly Wisdom, episode number 44. And before you go, let's do a couple of things to make sure we spread the good word. If you're watching on YouTube, click the bell to get notified, hit that subscribe button. And if you're watching on Facebook or LinkedIn, leave us a comment, hit the like and share, and let's spread the news so that more and more people can become financially literate, just like you are, by watching these videos. And we'll see you again next week for another episode of Woody's Weekly Wisdom. Cheers.